Our story starts in Germany, 1923. Imagine this: people pasting wallpaper with banknotes, or literally burning money to keep warm. The Deutsche Mark had become so worthless it wasn't even good enough to use as toilet paper. Prices were doubling every 2 days. The annual inflation rate: a mind-boggling 1.510 That's basically infinity. And then we have Zimbabwe, 2008. They printed that infamous banknote, 100 trillion Zimbabwean dollars. Just reading all the zeros feels exhausting. At that time, prices were doubling every 24 hours. Their annual inflation rate reached 7.3118. Honestly, I can't even imagine what that means. Now fast forward to 2022. Inflation suddenly spikes again in the US, Europe, and the UK. And suddenly, the word inflation is everywhere. In the news, in the markets, and even in family dinner conversations. Don't worry though, I've dug into this mess multiple times. And in this video, I'm going to help you not just understand it, but actually enjoy learning about it. So, what exactly is inflation? At its core, inflation means currency depreciation, your money losing value over time. The most common way to measure it is through the Consumer Price Index, or CPI. That's basically a basket of goods and services that regular people buy. Take the US as an example. About 60 years ago, the CPI stood around 29. Today, it's about 296. That means prices have gone up almost 10 times in 60 years. Put simply, $1 back then has the same buying power as about $10 today. And it's not just the US. In China, the trend looks similar. In Australia, prices rose about 16 times over 60 years. The UK, 25 times. India, 88 times. And Turkey? Get this, a whopping 9.7 million times. So no matter where you look, the story is the same. As prices go up, money is worth less and less. Now, economists have come up with tons of theories to explain this. Keynesian, monetarist, neo-Keynesian, blah blah blah. They all sound super clever, but none of them have proven to be consistently useful in the long run. And honestly, that's one of the fascinating things about inflation. Because at its heart, it's actually pretty simple. Think of it this way. Inflation happens when there's too much money chasing too few goods. If the supply of money grows faster than the supply of stuff to buy, prices go up. That's it. That's the core idea. And that's why central banks exist. Their number one job, in some cases their only job, is to keep prices stable. They can print money, adjust interest rates, and pull all sorts of fancy levers. But in the end, it's all about one thing: keeping inflation under control. The problem? It's not that simple. Even at the Federal Reserve or the European Central Bank, where the brightest economists gather, they argue with each other all the time about what to do. And that's why inflation is such a tricky beast. So let's dive deeper. Let's step into the shoes of an entire economy and see how money really works as a tool for circulation, and why it gets so complicated. For example, whether a cup of milk tea costs $3 or $300 doesn't matter much. What we truly seek is more enjoyment, more happiness. But let's not go too deep into that today. From an economic perspective, what we're really chasing is higher output. In simple terms, higher GDP. If everyone works harder, produces more, and creates better products and services, then as consumers, we all get to enjoy them. This makes the economy run more efficiently, which is exactly what we want. So how does currency help us achieve this? Normally, we think of money simply as a medium of exchange. Ideally, it should be stable. $100 today should always buy the same basket of goods tomorrow. That stability helps the economy function. But over time, people notice something. Money in our hands isn't constant. Its value slowly depreciates due to inflation. Hiding cash under your bed might feel safe, but inflation gradually erodes its purchasing power. That value doesn't just vanish, it gets transferred to newly created money. In a way, inflation constantly makes small adjustments to everyone's wealth. It prevents people from getting too comfortable, discourages hoarding, and pushes us to work harder, spend more, and produce more. Inflation is essentially a continuous redistribution of wealth. Take milk tea as an example. If this year it costs $20, but next year it's $21, then money left unused loses value. That encourages people to spend now instead of later, which boosts consumption, raises aggregate demand, and drives GDP growth. Inflation, in this sense, acts like fresh water being poured into a stagnant pond. It keeps the economy moving. This is why most economists believe a moderate level of inflation is healthy for the economy. Of course, as consumers, we dislike feeling forced to spend, which is why inflation is often included in the so-called misery index. But for economists, economic growth far outweighs that discomfort. Now, what about deflation? With deflation, $100 today buys you more tomorrow. Your wealth increases simply by saving. Sounds good, right? But here's the problem. If everyone believes prices will keep falling, people stop spending. Why work harder when your savings grow in value just by sitting idle? People reduce spending to the bare minimum and lie flat. Over the long run, this creates a dangerous deflationary spiral. Japan is a classic case. After slipping into deflation, it faced a credit crisis. For decades, despite aggressive government spending and central bank stimulus, demand remained weak. Cultural factors and an aging population made things worse. The result? A stagnant, low-desire society. So you see, the real danger of deflation isn't cheaper prices, it's collapsing demand, reduced output, and a society that stops striving. But inflation can also go too far. For example, if $100 hidden under the bed buys 100 cups of milk tea this year, 99 cups next year, and 98 the year after, that's manageable. You just work harder to keep up. But if it turns into hyperinflation, things unravel quickly. Imagine being able to buy 100 cups today, only 50 tomorrow, and none by next week. In that scenario, saving becomes pointless. Money burns in your hands like a hot potato. You spend it as soon as you get it. That's exactly what happened in places like Zimbabwe and post-WWE Germany. In Germany, a loaf of bread once cost 100 billion marks, and 2 days later, it doubled to 200 billion. The economy collapsed. In just 6 months, 6 million people lost their jobs. The financial system broke down, political chaos followed, and Hitler rose to power. Hyperinflation destroys everything: the credit system, productivity, and social order. Every nation that has gone through it needed painful reforms and years of rebuilding to recover. So, to summarize, deflation freezes an economy, stalling growth and innovation. Hyperinflation overheats an economy until it burns out completely. Both are devastating. That's why economists put so much focus on maintaining stable, moderate inflation. We've already talked about how damaging deflation and hyperinflation can be. Now, let's go one step further and understand why most economists aim for just the right amount of inflation. It's really a matter of balance. For example, the central banks of the US, EU, Japan, Canada, and Australia all target an inflation rate of about 2 to 3%. Other central banks may not announce a specific number, but they generally aim to keep inflation within 2 to 5%. Whatever monetary policies they adopt, their main goal is to keep inflation within this reasonable range, even if that means sacrificing short-term growth or going through a brief recession. In today's developed economies, keeping inflation under control is the absolute bottom line. Now you might wonder, how does inflation affect asset prices like stocks or housing? In theory, you'd probably assume there's a positive link. Prices rise, so to protect themselves, people invest in assets like real estate or stocks. But in practice, things look different. Let's take the IMF's regression study across 71 countries. It shows that stock prices and inflation usually have a negative correlation. In other words, when inflation is high, stock markets tend to fall. Why? Because the real driver isn't inflation itself, it's government policy. During high inflation, central banks often tighten monetary and financial policies to curb prices. Those tighter policies usually push stock prices down. Of course, there are exceptions. In Turkey, for instance, policymakers didn't tighten during inflation, which is why stock prices there tripled in a single year. Another exception is energy companies. Historical data shows that during high inflation periods, energy stocks often perform very well. Just look at 2022, when ExxonMobil ended up being one of the best-performing companies globally. So why does inflation happen in the first place? The simplest explanation is that central banks print too much money. While that can be true, it's not the full picture. Sometimes, even without printing money, inflation can still happen. Other times, central banks can print endlessly without triggering inflation. Japan's experience over the last 20 years is a good example. Broadly speaking, there are three key drivers of inflation. Let's start with the first: demand pull inflation. Imagine a normal, functioning economy. One day, for some reason, everyone suddenly craves milk tea. Overnight, demand surges. Every milk tea shop in the country gets excited, and two things happen. They produce more, and they raise prices. Either way, shop owners make more money. With higher profits, owners can spend more on food, clothes, and other goods. If they're generous, they might even raise salaries or pay bonuses, giving their employees more spending power too. This cycle boosts other businesses, creating a ripple effect across the economy. In short, a surge in demand leads to more production, higher prices, rising profits, and stronger consumption. That's the logic behind demand pull inflation. It's both the fuel for economic growth and, at the same time, the source of rising prices. Demand, after all, is the real engine that drives social progress. So, just now, we talked about demand pull inflation, how it can actually drive economic growth. And that's why, when governments want to stimulate the economy, they often start by boosting aggregate demand. But here's the catch. The side effect is usually inflation. What does stimulating the economy really mean? Simple. It's about motivating people to spend money. Buy milk tea, buy bags, buy anything. Governments can do this in a few ways. They might spend money directly, like on infrastructure. They might give subsidies. Or the easiest way, just hand out cash, like many Western countries did during the pandemic. Remember those lockdown days? Nobody was buying milk tea. Demand had collapsed. So governments started printing money. Yep, the central bank from the US, Europe, Japan, and the UK, all pumping money into the system to kickstart demand. But here's the funny thing. Economic growth and inflation always come as a combo deal. Buy one, get one free. The trick is timing. If you stimulate at the right moment, you can get growth without too much inflation. Imagine this. If a milk tea shop is quiet, with idle staff and plenty of ingredients, and suddenly a wave of customers come in, no problem. They can handle the demand without raising prices. That's pure GDP growth. But if the shop is already jam-packed and the government pushes more customers in, what happens? Prices skyrocket, but production doesn't really increase. That's inflation. So the difference boils down to whether the economy still has spare production capacity. How do we measure that? Easy. Look at the unemployment rate. High unemployment? That means lots of untapped workers and production potential. Stimulus will drive growth. Very low unemployment, like 2% or 3%. That means almost everyone is already working. The economy's running hot. Push more demand in, and it just overheats. Prices rise instead of output. That's why economists talk about the Phillips curve. Inflation and unemployment usually move in opposite directions. Look at the US a few years ago. Unemployment kept falling, job vacancies hit over 10 million, and companies were raking in record profits. But the labor market was maxed out, like an overcrowded milk tea shop. And what happens when the shop is too busy? Yep, prices go up. Inflation. And yet, the Fed kept doing quantitative easing, printing money, keeping rates low. No surprise inflation shot up. But here's where it gets tricky. Printing money doesn't always flow into the real economy. Central banks can lower interest rates and buy bonds, but if commercial banks don't lend and financial institutions just park the money in stocks, it never reaches people like you and me. It just circulates inside the financial system. That's exactly why, before 2020, countries like the US, Japan, and Europe kept printing money, but still couldn't get real inflation. All we saw was rising stock markets, not higher consumer spending. Then came the pandemic. Governments realized printing money wasn't enough. They had to put cash directly in people's pockets. Remember those checks? In 2020, almost every American got $100 plus $500 per child. If you lost your job, you got another $600 per month. Then, in 2021, if you earned under $75,000 a year, you got another solid $400. All in over 2 years, the US handed out around $5 trillion. That's about $15,000 per person. Historically, governments only print and spend at this scale during wars or crises. And they know the risks. Hyperinflation in Germany after WWE, Hungary after we were Tuhu, all caused by desperate money printing. But desperate times call for desperate measures. And when governments print money, demand surges. And that, my friends, is demand pull, inflation in action. So here's the catch. When governments keep printing money, inflation starts to shoot up. At first, it might just be 40% or 50%, not yet hyperinflation, but dangerous enough. And here's the twist. Once people notice prices keep rising, They stop saving and think, I just need to spend before my money loses more value. But if everyone's working less and producing less, what happens? Supplies drop. Fewer goods in the market means prices go up again. That's called cost-push inflation, and it makes inflation climb even faster. Imagine an endless loop: less supply, higher prices, even less incentive to work. Repeat. Now, here's one of the most fascinating parts of economics: expected inflation. This means inflation can actually happen just because people expect it to happen. Sounds like Murphy's Law, right? What you are afraid of will happen. Think about it. If you believe prices will rise tomorrow, you'll probably spend more today. Maybe even stockpile things, like buying extra milk tea because you're worried it'll cost double next week. If everyone does this, money moves around faster. Even though the total amount of money in the economy hasn't changed, its circulation speeds up, and that alone fuels inflation. Crazy, isn't it? That's why central banks don't just fight inflation with interest rates or money printing. They also fight it with words. Notice how Fed Chair Jerome Powell always speaks calmly. Even when inflation hit 5%, he called it transitory. Later, as prices kept climbing, he still looked calm, saying, "Don't worry, we've got this." Why? Because if the public panics, expected inflation becomes real inflation. And here's the scary part. Once expectations are set, inflation is really hard to bring back down. That's why central banks treat inflation like a monster. If it panics, everyone panics. So in 2022, when the Fed raised interest rates by 0.75% at a time, that was huge. It crushed demand, tanked the stock market, and made investors super nervous about a recession. But the Fed didn't stop. Why? Because in their logic, it's better to take the pain of recession than let runaway inflation spin out of control. And now you see the big picture. Inflation isn't just about money printing. It's about human psychology, expectations, and how central banks manage both the numbers and the narrative. I know this video was a little lengthy, but I hope it gave you a full picture into what inflation is all about. If you found it useful, subscribe and follow to give me the motivation to keep producing videos like this.